every Monday to Friday. This is Peter Lewis's Money Talk.
Money Talk.
Good morning and welcome to Wednesday. We're halfway through the week and there are just 3 days left in the year of the rabbit. This is Peter Lewis welcoming you to Money Talk for the 7th of February. This podcast is sponsored by Surfing Group, which is headquartered in Singapore and offers online financial services to 30 million customers across 10 countries. In today's business and finance headlines, Australia's central bank left interest rates on hold but cut its growth forecasts for the economy as weaker consumer spending hurts the country's outlook. The Reserve Bank of Australia held rates at 4.35% following its first meeting of 2024. It said that it expects fewer rate cuts to be implemented in Australia compared to peer economies, despite signs that inflation is easing. The RBA cut its projection for GDP growth to 1.3% by June 2024 from 1.8% forecast in November and lowered its estimates out to 2025. Thailand's Prime Minister Srettha Thavisin is urging Parliament to approve a plan to give one-off payments of 10,000 baht, that's $280 to about 50 million low-income citizens via a digital wallet, and setting him on a collision course with the country's central bank governor. On Tuesday, Mr Srettha reiterated his call for the central bank to lower rates, saying a cut of 25 basis points wouldn't stir inflation. The Thai central bank, which holds its first rate-setting meeting of the year today, has kept its policy rate at a decade high of 2.5%. Rising sales of hybrid cars helped Toyota beat estimates in the third quarter as the world's largest automaker raised full-year profit forecasts. The Japanese company increased its operating profit forecast for the year to $34 billion and shares of Toyota jumped almost 5% in Tokyo following the results. Chinese equities rebounded on Tuesday as state funds vowed to step up share purchases in an attempt to put a floor under months of sliding prices. Shares began climbing after Central Huijin, an investment arm of China's sovereign wealth fund, said it would expand its purchases of exchange-traded funds. The China Securities Regulatory Commission also said it would encourage institutional investors to hold A shares for a longer period of time. And Bloomberg reported that President Xi Jinping will discuss the stock market with financial regulators, stoking optimism about more concerted efforts to stop a slump in the market. On today's programme, I'm joined by Enzio von Pfeil, Capital Preservation Specialist at Financial Shield, and William Marr, Chief Investment Officer at Grow Investment Group. And if you want to get in touch, I'm sure you know the drill by now. You can go to my website, peterlewismoneytalk.substack.com, or post on my Facebook page, Peter Lewis Money Talk, and on X, I'm at Money Talk R3.
Peter Lewis's Money Talk.
On Wall Street Tuesday, US stocks rose with relatively broad gains across the S&P 500, overpowering a slide in heavyweight tech stocks. The S&P 500 climbed 0.2% to settle near the session high at 4,954. The Dow jumped 141 points or 0.4% to end at 38,521. The Nasdaq Composite inched up 0.1% to close at 15,609. US-listed China stocks bounced on Tuesday following a rebound in Shanghai and Shenzhen earlier in the day. Bilibili was one of the biggest gainers. Its ADRs surged 12.2%. VNet Group leapt 10.6%. XPeng that added 11.7%, while Li Auto rocketed 10.5% higher. JD.com, that was up 7.7%, and Auto Homes surged 11.8%. New York Community Bank Corp fell more than 22% to hit its lowest level since 1997. That follows a 42% loss last week after it took a $552 million provision for credit losses and cut its dividend to shore up capital. NYCB took over the failed Signature Bank during the regional banking crisis in 2023, and the KBW Regional Banking Index lost 1.4%, and that index is down 15% now from its December highs. Traders bought US government debt amid the regional banking fears. The yield on the 10-year Treasury was down 8 basis points to 4.09%, and the yield on the 2-year note dropped 8 basis points to 4.40%. In the FX markets, the dollar was sold broadly through the US session as yields fell. The yen ended the day 0.5% firmer at 147.9 yen, following a Reuters report saying the Bank of Japan is on track for a policy shift by April. In Shanghai, the yuan was boosted by stock market support measures, climbing 0.1% to around 7.19 renminbi to the dollar. Gold ended the day 0.5% higher at $2,035 an ounce, and the Brent crude oil contracts for April settled at $78.59 a barrel, up 0.8% on the day. Chinese equities rebounded on Tuesday as state funds vowed to step up share purchases. After some wild swings on Friday and Monday, the CSI 300 closed 3.5% higher on Tuesday. The broader CSI 500 index closed up almost 8%, and its small cap counterparts, the CSI 1000 index, closed 7% higher. In Hong Kong, the Hang Seng Index closed 627 points, or 4% higher, at 16,137. That's its biggest rise since July the 25th. And the Hang Seng Tech Index closed with gains of 6.7%. It does look like the rally may continue this morning. Futures markets pointing to further gains of about 115 points in the Hang Seng, projected to open at 16,250. And you can get more details on the latest market movements in my daily newsletter at peterlewismoneytalk.substack.com.
Every Monday to Friday, this is Peter Lewis's Money Talk. Peter Lewis's Money Talk.
Let's welcome our Wednesday morning guests. It's Enzio von Pfeil, Capital Preservation Specialist at Financial Shield. Morning, Enzio.
Morning to you.
And also with us is William Marr, who is Chief Investment Officer at the Grow Investment Group. Very good morning to you, William.
Good morning, Peter.
Now, as you heard there, Chinese equities rebounded as state funds vowed to step up share prices in an attempt to put a floor under what's been really months of sliding prices. An investment arm of China's sovereign wealth fund is going to expand its purchases of exchange-traded funds. The regulator, the CSRC, will encourage institutional investors to hold A shares for a longer period of time. And even President Xi Jinping is getting involved. Bloomberg reported that President Xi will discuss the stock market with financial regulators, and that's stoked optimism about more concerted efforts to stop a slump in the market. Enzio, haven't we heard all of this before? Why is it going to be different this time, all these support measures?
We've heard it before, and the Teflon Band-Aid won't be different. What we're seeing is yet again that people are fiddling around at the symptoms, not at the causes of what's going on. What's going on in my mind is this party-state capitalism has gripped the markets, whereby the government decides through its party cells and individual companies what needs to be done. That then thwarts the 80% of the employment growth which private companies really do, and that in turn thwarts the economy, the economic growth. So I'm just of the view that he's not going to get anywhere by fiddling around with this, let's inject more money, because it's like a Teflon Band-Aid. It just won't stick. It can't stick.
And presumably you've got to keep on doing it. Can't just be a one-off,
Yes.
because as soon as if you don't solve the underlying problems, the market will just sink again once the support efforts come to an end, and they've got to start all over again.
And one major consequence of that has got to be that he's going to irritate even more a lot of the local stockholders in China, that the normal people who own stocks and shares. I think that's the real domestic danger for him.
It sounds like they just don't want people to sell at all. It's not just short selling that's being banned. They're actually twisting the arms of fund managers to not sell their current positions either. Hedge funds can't close out some of their positions. It's sort of like becoming a totally manipulated market, isn't it?
Well, even more, because they're not only telling what the private companies through these 1% shareholdings in private companies what to do, but then, of course, as you're saying, they're with the CSRC said it would punish malicious short selling and stop illegal behavior. So, but I think it's really flaying on the outside at the causes, not at the symptoms, not at the causes, and that's the danger that I see. That's why China just should not be touched for many months, if not years, until this party-state capitalism ends.
Okay, well, I want to talk more a little in a moment about the causes, but William, let's bring you in here. What do you think about all this intervention from the authorities, and even going all the way to the top, to President Xi Jinping by the sounds of it?
Well, I think as a fund manager, we have to go back to the basic and fundamental. And there are a couple of, reason that I think there is a short-term technical rebound. But in the long run, we have to go back to the fundamental, meaning company earnings and country GDP growth. In terms of earnings, actually, we are seeing the whole, China market potentially, we are talking about 10% earnings growth this year. So if that is being delivered, I think at least, the numbers speak for itself, same as, 5% GDP expected growth. In the short term, I think I agree with Enzio that, just the government funding to the market is not enough because at the end of the day, we have to attract more, local, retail or institutional investor, and to some extent, global investor, back again. There are short-term technical rebound is because I'm seeing sentiment quite mixed. I think a lot of investors, they are not trading if you look at the market volume. But at the same time, there are some technical, guys coming in to buy the dip on the market. Like I got a call yesterday from a U.S. endowment deputy CIO. They asked me whether, this is a bottom, whether they should start some position. So I would say in the near term, there would be some people coming in to do the bottom fishing. But in the medium to long term, we have to go back to the earnings and GDP.
So do you think that if the authorities didn't get involved, the market may well rebound anyway if it's of its own accord, because as you say, there are people who are looking at maybe trying to get in at low valuations or low levels. Do you think it will be better if they just stepped aside, let the market find its own level and let buyers naturally come in?
Well, they did. If you look at the 3,000 points kind of light defense war, it has happened, a few times. Like, late last year, I don't think the intervention on the regulator is that high. But at the end of the day, the market correct. And there is also some structural product like snowball, being locked out. I think that caused some of the sentiment and also market drawdown this year. I would say right now is the peak in terms of tools that the regulator is trying to use. I'm seeing a 300 degrees kind of like tools everywhere in terms of sector, in terms of, market support and intervention. And I think all we need from my perspective is time.
Does it, as a fund manager, does it worry you when you see this intervention? Because the risk, of course, is that if you start buying, you may not be allowed to sell again.
Yes, but this is not a new thing, right? So late last year, I think there are rumors saying that some of the mutual fund company, they are being kind of like advised to keep their long position. So I don't think this is new to the market per se. At the end of the day, I think people has gone through, the post-COVID kind of like challenges already. If, from my perspective, earnings coming back again in good sectors, I think that is the key points for investor confidence to coming back, rather than any more different type of, stimulus or support.
Enzio, you were saying earlier that this is not going to work unless you go and address the underlying fundamental problems. Yes. What are the underlying fundamental problems that need to be fixed?
Well, there's one singular problem, which is income insecurity. And that is being driven by the party-state capitalism, because it's the party now telling the party cells within individual companies, telling the companies basically what to do through these so-called management stakes, which give them extraordinary powers. Despite even having just a 1% share in the company, they can pretty much tell the company what they need to do also, because you know who is behind them. So until the private sector is allowed to create demand-driven jobs as opposed to jobs by fiat, we think there should be more pig farmers in Sichuan province next year. Until they're allowed to create more demand-driven jobs, you will find this economy really stagnating and becoming quite a danger, also perhaps even just geopolitically, because things aren't going to go anywhere. But again, it's this adherence to this party-state capitalism. I think that's very much at the root of the problem. Next, of course, the economic time being pretty bad, excess demand for money and excess supply of goods, but that's cyclical. I'm talking now more about a structural, fundamental problem, as you were.
So to fix structural problems, you need structural reforms, don't you? And
yes.
Messing around with the market isn't a structural reform.
No, it's throwing a Teflon Band-Aid at a forest fire. It's just not going to work. It cannot work.
And what does it say about the fact that President Xi Jinping himself is personally involved now in what's going on in the markets? I don't mean his buying himself, but he certainly seems to be concerned about it. Why is that?
Well, because he knows, I suspect, that it's going to all along lead to social unrest, if not already. I'm not sadly equipped to read or speak any Mandarin or read Chinese. William can maybe sort of enlighten us, but I can't imagine that it's all tickety-boo on the social happiness front in China, because people are losing their jobs. The unemployment rate amongst the youth is 25% or so. Let's not get too hung up on whether it's 20 or 25. It's a very large number. So I think that he sees these problems coming, but again, it's his adherence to this party state capitalism. That's the root of he's shooting himself in the foot, in my mind.
William, what do you take from the fact that President Xi is getting involved? Do you see that as giving you some confidence that maybe Beijing is going to take more dramatic and direct support, or how do you see it?
Well, if you look at the market participant reaction yesterday, it definitely is. But from my understanding, actually, the senior regulator has been keeping a close eye, on the equity market situation. In particular, I think it's all about, consumer confidence. And we have been keep talking about, the wealth effect from the real estate and the equity market. With the real estate market going down, I think the wealth effect has been, challenging, and equity market is not going anywhere. So to be honest, I think this is not a new news, domestically in China, but I think in global, it triggers some of the foreign flow. Yesterday, global flow to China is the highest, in the last 18 months, I was told.
Yeah, so foreign investors, I mean, some of them have been saying this market is uninvestable at the moment, but as you say, there are others that must be looking at buying right now, because we are seeing inflows again from foreigners, record amounts for this year so far. So presumably there are foreign investors who are very tempted by the market at this level.
Well, yes, I think that is why, we have an equity market. If there is no market turnover, if there is no buyer, that means there is no exchange of view. So as long as the market has volume, right now, I think in normal times, it's about 1/3 of the peak market turnover, like 1 trillion renminbi right now is about 30% of it. So when the volume resumed to half of 1 trillion, I would say the market is back to a healthy level. And I think another reason is this year would be a volatile year, no matter in China or in global. So that's why, I think some investors are also looking to take some profit from other country and rotate to the country with, cheaper valuation. And definitely, I think Enzio would kind of like also point out that the risk or the volatility in the China market is also quite high.
Yes.
Well, it does seem there is quite a substantial shift going on in global markets, because these billions that are being pulled out of China, much of that cash appears to be heading for India. And we've got some of the big US investment banks like Goldman Sachs and Morgan Stanley endorsing India as the prime investment destination for the next decade. The Marshall Wace says it's positioned India as its biggest long bet after the US in its flagship hedge fund. Vontobel says it's making India its top emerging market holding. And several others are looking at buying. Even in Japan, retail investors there are starting to embrace India. So where do you see this? Do you see sort of India as being a major beneficiary here? Enzio?
Oh, absolutely. The economic factors, first of all, to state the obvious, India is not practicing China's party state capitalism, so that's the huge benefit. And the other one is that the population in India has eclipsed China's, things that everybody's actually known for a long time. So I think it's very much the real reason for India is it's a great replacement because of this party state capitalism, which the Chinese have had for a long, long time. It's not new, but they're really pushing it more and more, and that's the problem. Of course, then India's also got is benefiting from geopolitical shifts with multinationals de-risking their supply chains. And also I believe the elections are still upcoming, I believe, in India. So that also is going to help in improving economic time and excess demand for goods coming through in India. So those are a few plus factors. But I think the main one is it's the backdrop of a very boring China that is quite febrile. And I think that's what's making India and Japan, by the way, countries of choice.
It seems that, if you're going to sell China, you've got to have somewhere else to go. And particularly if you're an emerging market investor, benchmarked to an emerging market index, you've got to find another emerging market to go to. And we haven't really had one until recently, but it does seem now that India is the one. We're seeing that, funds have put 50 cents to work in India for every dollar they've pulled out of China since last year. So this does seem to be the go-to market at the moment, doesn't it?
I think it's absolutely. And again, I'll say it one final time. It's because of China's party state capitalism that's really what got the ball rolling. And I'm not seeing that change in China. Thus, the Indian ball will continue rolling along with some pretty good economic time in India. Excess supply of money, excess demand for goods.
William, is India a market that you look at?
Yes, I've been investing in India, I think, for almost 20 years. So the key question to me, Peter and Enzio, is how much capital you want to take away from US. I think the bigger question is DM versus, EM, as you mentioned. I think a lot of bet globally is too concentrated on US dollar and the Magnificent Seven and the global, growth tech. And for a year like this year, I'm expecting global volatility due to geopolitical, due to the war, due to, other reasons, the election. I think it could be very volatile. So if you want to diversify the concentrated bet in US where you want to go, I think EM is a bigger question. And then within EM, how to allocate between Japan, India, and China. Is an investor choice. What you want to go for momentum, you want to go for cheap valuation, and then you want to go to a certain sector. My view is I do see a lot of so-called alpha opportunity, in China right now, and India. I think it's a momentum trade, so there is no harm that you take trade or diversify portfolio on a few countries.
It's probably the case, isn't it, that India's market has got quite expensive over the past few months. It's reached several all-time highs recently. So it's trading, about 20 times earnings now, forward earnings, I think, isn't it?
Well, it's cheap, Peter, because if you remember, we always talk about, US expensive, China, Asia is expensive. I think, same cases can be applied to India. I do see a momentum is going there, but at the same time, I also notice, the India retail people, they have been quite bullish as well, using leverage to go into the market, in particular in the mid and small cap space. So I think for global investor, maybe it's better to invest in the top, Nifty 50, maybe some of the auto sector, rather than go to the mid-cap space because those sector could be quite volatile if a margin is being involved.
But we must warn that India's not going to be an easy ride either, is it? I mean, it is a difficult country to invest in because ultimately, despite the economy growing fast, it is still a largely poor country. It's not so easy to get into the market. So presumably, if people go into India, they shouldn't expect a smooth ride there either.
Yes, and I think, one key observation, Peter and Enzio, I had last year is I always, suggest and advise my global peer group to invest in other country because of the pull factor, not because of the push factor. I've seen too much a push factor that, fund manager redeem from China exposure or they sell Hong Kong shares. And then because of they need to redeploy the capital within the bucket, and then they invest in Japan and India. I think that could cause some short-term, mistake or volatility because they're not seeing opportunity in that country because they like them or they've done a lot of research.
Enzio, how much is the political aspect important for investors here? Because there are foreign investors who see sort of China as a threat to the Western global order, and India is seen as a sort of potential counterweight to that, isn't it? And also setting itself up as a potentially a viable manufacturing alternative to China.
Well, going very much back to my days working with Capitol Hill, absolutely. India's a good guy, and China, well, they're all communists anyway, according to the Americans, and so they're bad guys. It's disgustingly simplistic how the people on the Senate Foreign Relations Committee, whom I was advising, were just so blinkered with what I call the arrogance of ignorance. So I think that the geopolitical does play a role, but for fund managers, as far as I had when I was advising them at Warburgs and Rothschilds, it seems as if that's very important. But ultimately, it's also just as William was saying, it's the earnings and the GDP growth that ultimately swings the cat to which way you're going to invest.
And also the investment cycle is picking up, isn't it? We had the budget, India's budget last week, and the finance minister announced the biggest increase in spending on infrastructure on record. So we're at the right point of the investment cycle, presumably.
Improving economic time, excess supply of money, excess demand for goods looming. So I think that that's also a very, very important thing. But again, I want to keep saying that China is not, it's not a clash of cycles. It's a clash of something fundamental in China, structural, which is this party-state capitalism. And then India is very much more of a cyclical story, not a trend story present.
I mean, William, we're getting a lot of foreign companies moving to India now, aren't we? Setting up production there. Also, technology companies want to go there because they're seeing the movement in supply chains. And also, you've got hundreds of millions of Indians who are getting now bank accounts, access to credit. This presumably is going to attract global companies to India, and then along with them, global investors too.
Yeah, I think it's good for the world. I think the whole earth needs growth post-pandemic. So we need people to consume, to spend more. And at the end of the day, a lot of countries relying on export, for, GDP growth. And India has actually historically been a good or big market for Chinese company as well. So I think, if Indian consumption can pick up, the pie from the losing pie in Europe, that would be good for everyone. And I've seen some Asian companies actually moving to India to take into the market, not just India, in ASEAN as well. If you see, Singapore, Malaysia, Thailand, I think they are also, or Vietnam per se, they're also, picking up or complementary to the China plus one story.
I'm wondering,
not to forget Mexico.
Sorry,
yeah, Mexico. Well,
I'm sorry. Yeah, you were going to say Mexico also, William. Absolutely.
I'm wondering, though, I mean, all these things that we've been talking about, the attractions of India, they are well known, though, aren't they? There's nothing new here. I'm wondering how much of this is already priced into the markets, because Indian shares have been going up now for 8 straight years. So we've seen annual gains for the past 8 years. Is it all priced in, do you think, or is there more to go?
Well, I think there are more to go. I think the biggest question as a global fund manager is how much you want to allocate to US. Because I think in the US, a lot of hope and kind of like good news is being priced in the market, no matter large cap and mid cap stocks. And should there be a global correction, there is no place to hide. So you can go back to the treasury, you can go back to the cash. So the first question I have in my mind is outside US, where can I, invest in companies and country with growth? I think, besides China, India and Japan, is a better place to be compared to some of the European country and maybe some of the other emerging market.
And are you reducing your investment in the US?
We are seeing opportunities in the mid-caps. For example, we are buying some mid-cap equity long-short fund because with the high rate environment, we are seeing a dispersion of the mid-cap companies in US going to be higher this year. Some company will be very successful because of the potential soft landing environment in the US market. But at the same time, we are seeing some mid-caps company not able or suffer from the so-called high labor costs as well as high funding costs. So some of the funds actually they're up 80% to 100% last year. And when we talk to them, they are expecting similar type of opportunity for this year in US. So in US, we are reducing large cap and rotating towards the equity long short in mid caps.
Are you seeing signs now that, you know, a lot of the gains in the US have been driven by these Magnificent Seven? Are you seeing signs now of a divergence among that Magnificent Seven, in that maybe some of them, like Nvidia, for example, like Meta, are going to carry on gaining, but some of the others are not so magnificent anymore? And I'm thinking maybe Tesla. We seem to be seeing more of a divergence now, and discriminatory behaviour among investors in picking them.
Well, from a sentiment perspective, Peter, the answer is no. You know, when I talk to some of the regional, institutional investor and some of my global friends, I think they still want to long the so-called AI themes and the tech themes. If you look at the Meta, stock price, huge increase, I think that explains for something. So I think the momentum is likely to be continued. But again, the opportunity from a risk reward perspective, I would say the mid cap long short is more kind of like attractive to us, because rather than one off, everyone know what to buy, and a simple long exposure.
Are you both worried about maybe we might be seeing a repeat of the 2023 regional banking crisis? There are some signs of some problems developing again, aren't there, in these smaller banks, particularly because of their exposure to commercial real estate. Enzio, is that a worry?
Well, it is, but I think I've worried about it so long that I'm giving up on worrying, if you see what I mean, because it's there, and I don't. It seems as if something will be done. I've just been totally wrong on guessing that it's going to be a bad scenario. So I'm just I've become very passive on this whole idea of trying to pick one of these faults.
What do you think, William? Is it something we should be concerned about?
I think we should more concerned about the US, election and the potential kind of like market volatility. On the banking side, after the Silicon Valley Bank and, other situation last year, I think a lot of retail deposit, and as well as, the regulator is already kind of like monitoring this. So I don't think it would become a systematic risk.
Enzio, just final thoughts on the US while we're there. What's your economic clock saying about the US?
Excess supply of money is still there. Excess demand for goods, but it's beginning to wane. So it's the excess supply of money that really gets people into markets. It's less the real economy. It's just if they have spare cash, they will put it into a market, treasuries or stocks at its most basic.
Okay, and William, let's get some final thoughts from you. We're coming up to the year of the Dragon. The Dragon years are supposed to be quite good for markets, aren't they? They're supposed to be quite positive, robust years.
Yes, I think don't expect or hope for something that we shouldn't hope for. I think everyone is waiting for the first rate cut in the States. If it's happening for the wrong reason, I think that would be a surprise. And second is, as I mentioned, I think there will be more surprise and volatility in the market. And thirdly, I truly think, investors should go back to the basic and fundamental. I know a lot of investors, they have question on the China-Asia market, but at the end of the day, we have to think about, we are also investing in companies. So whether those companies, they are making profit or generating economic interest is the key. For example, I've ordered an Apple Vision Pro, a very magnificent, products. 30% of the component is actually being manufactured in China, some of the high-end manufacturer. And those companies are listed in China-Asia market. And unfortunately, some of them are down 50% last year, and they are growing at 30% earnings. So while there are some policy, kind of like concern or market volatility, but I think as a fund manager, if we can go back to the company level, look at the business model, look at our outlook, that would be the most kind of like highest confidence or predictable things, as an investor.
Okay.
Absolutely, yeah.
Well, thank you both very much for your thoughts there. Very interesting discussion this morning, and I wish you both a very happy Year of the Dragon coming up on Saturday, of course. You heard there William Marr, who's Chief Investment Officer at the Grow Investment Group, and also our regular Wednesday morning commentator, Enzio von Pfeil, who is Capital Preservation Specialist at Financial Shield.
You're listening to Peter Lewis's Money Talk.
Money Talk.
Thank you for listening this morning. Just a reminder once again to take a look at my website, peterlewismoneytalk.substack.com, where you'll find my daily newsletter with a lot more business and finance news to go with this show. I'll be back tomorrow when my guests will be Andrew Ferris, the CEO of Econosis Advisory, and Sunil Kashyap, Director of FinMet. And with a view from Taiwan is Ross Feingold, Director of Research at Cyrus Consulting in Taipei. Please catch me tomorrow.
Money Talk